It's a good world. Good world going bad.
Welcome back to Real Estate Mindset. The housing market continues to get beat down while still remaining toxic overall for new and even existing homeowners. And the question is now that we have begun the spring home buying season, is the quantitative tightening, the high interest rates, and overall the overwhelming unaffordability enough to finally get the housing market towards a path of balance, which is to say, is the housing market going to crash? And really the question becomes, what is a crash? And I'm going to tell you guys right now, more than likely what a crash means to you is your ability to get a good deal or at least a home that you can afford. And what I'm trying to tell you guys is you have to understand what a good deal even is, because right now there are still diamonds in the roughs. And if you guys don't know and understand how to purchase real estate with fundamentals, odds are it will be harder when we finally get into a recession. And so the thing is, guys, you want to make sure that you can qualify as best as possible right now, because any type of collapse would require even stronger purchasing power than what we have right now. So we'll dig into Redfin and several other data sets, but the name of this Redfin article is Housing Market Update. Listing sales stumble as sellers and buyers take Easter break. I'll read you guys two paragraphs and then we'll dig right into the data. Now, their intro paragraph is growth in new listings slowed this week and some sellers press pause over Easter. Housing costs remain stubbornly high, detouring some buyers, but Redfin economists say cost could come down soon. But they don't explain really why costs can come down soon, but it is what it is. And this last little optimistic bit here, you guys, buyers may get a break on housing costs in the coming months. What? We will? How will that happen with interest rates going up and prices not going down enough? How will that happen, Redfin? Let's continue. Daily average mortgage rates rose this week because of some disappointing economic news. But if the upcoming job and inflation reports show that the economy is headed in the right direction, the Fed is likely to confirm that they will cut interest rates in June, which would lower mortgage rates. Home price growth could soften as spring goes on if new listings regain the momentum we saw before Easter. So you guys can see, in other words, they're not telling us, okay, and under what conditions would they lower interest rates? Okay, well, understand that they lower interest rates to stimulate the economy and to stimulate the markets. And right now, the last thing that we need to do for the housing market is to stimulate it. So what is going to be more affordable absent additional price decline? What could it be? Are we all getting raises this year? Are we getting a universal raise in real income? I haven't heard anything about that. Comment below. Have you guys heard about any type of universal income where we all make 40% more income? I don't think so, guys, but let's get back to the data. All right, let's take a look at this week's leading indicators, and I'm also going to pull up Mortgage News Daily to compare their data, but starting with mortgage rates, guys. So mortgage rates are up to 6.91%. Now, when I go to Mortgage News Daily, at least from the date of the recording of this video, you guys can see that interest rates are actually over 7% once again, as the recording of this video, sitting at 7.01%. Now, this is for conventional mortgages. You guys will notice that FHA actually has lower mortgage interest rates than even ARMs or conventional mortgages. So usually FHA is about 50 basis points lower and VA is about the same. Now, remember what I've been telling you on my live videos. Generally, you guys will get a better deal if you go to a broker versus going to a direct lender. Now, this is saying weekly mortgage interest rate averages are 6.79%. Now, when we go down here and really kind of pick apart demand, you guys can see mortgage purchase applications are down 13% year over year. But when we dig deeper and we look at the actual mortgage purchase applications, you guys, we have never, and you see here the composite index is sitting at roughly the low 200s. We haven't had this type of decreased demand in mortgage purchase applications since, look at this, guys, since 1997. We are all the way back to 1997 levels of mortgage demand. How is that not? How is the housing market resilient if no one wants or can even buy a house? Obviously, people understand that things are way too unaffordable right now. Now, when we go further down this list, we can see Redfin home buying demand is also down 11% year over year. When they talk about touring activity, that's all over the place, you guys. And then when we talk about homes for search, that's down 13% also year over year. But take a look at sales transactions. So here's sales transactions of existing homes right now. And you guys can see we're basically on pace to have a slightly under 4 million sales. Now, if we go back, there's only a couple times during the GFC, very, very quick, that we had that level or lack thereof sales. You can see right here in 2010 and right here at the beginning of 2009. Now, before that, you guys, we had to go all the way back to about the 1990s. You can see that right here to get under 4 million sales. So not only are mortgage purchase applications in the gutter, as you can see here, when we look at the big picture, we go back to the 1980s, you can see also sales and transactions are in the gutter. Demand right now is crippled. Okay, guys, let's take a look at this week's winners and losers. Now, understand this isn't monthly median prices. Okay, so this is not comparing month over month. This is comparing a 4-week rolling average, and this is updated every single week. It's a nice little data set to review. I don't trust the data for obvious reasons, but let's look at the top 5 winners this week, which was number 1, West Palm Beach, sitting at an increase in median sales price of 19.1%. That's followed by Anaheim at 18%. And then San Jose, surprising to see San Jose up there. I really am, sitting at 15.9%. So that's number 3 for this week. Number 4, Providence, Rhode Island at 14.3%. And another usual suspect with Miami, sitting at number 5 at an increase of 14%. Now, the interesting thing is this week, Redfin is only showing one metro area on the year-over-year decline list, which is San Antonio, with a decline of 0.3%. But don't forget, they are only telling us about the top metro areas. In fact, I've been tracking additional metro areas that do show year-over-year price decline. One of those metro areas being Jackson, Mississippi, sitting at a decline, okay, of 37.5%. So that is a massive, there's no seasonality here. There's something seriously wrong going on in Jackson, Mississippi. I've also been following Birmingham, Alabama. Now, Birmingham, Alabama is also down 7.5% year over year. And I'm wondering how much further is Birmingham going to go down? But right now, again, 7.5%. Now, I also added Myrtle Beach to my list to watch because I drove there. And when I drove there and did a metro tour in Myrtle Beach, I was shocked. I was shocked at the amount of new construction that was going on there and the lack of infrastructure, the lack of jobs. And so we finally start seeing Myrtle Beach go down. In fact, they're down 6.4% year over year. In addition to that, I find it very interesting as well that Boise cannot get off this list. Boise is also down 6.3% year over year. Now take a look at the surge of listings. Now I've been keeping my eye on inventory because the name of the game this year in 2024 is sustained inventory. So that is the phrase of the year, sustained inventory, because that's what we need. Now, San Jose is the number 1 metro area. That's crazy, at 41% increase in new listings. Number 2 is Phoenix. Keep your eyes on Phoenix, specifically Surprise, Arizona. Number 3 is Sacramento at 25%. Jacksonville, Florida is 23% at number 4. And Austin, not good for Austin, is at 21%, sitting at number 5 of all metro areas that they are tracking. Now, don't forget, it's important to look at the big picture. Looking at the big picture means looking at the last decade to half a decade at home prices so that we can filter out things like seasonality. I have heard this so many times. People yell and scream like, oh, the prices are only going down. They only went down. They only went up because of seasonality or shrinkflation or any of those things. But people continuously, those same people making those arguments, always fail to acknowledge that we are experiencing quantitative tightening. They fail to acknowledge that home prices went up 40% in roughly 3 years at the same time that real income went down. They forget to mention the overwhelming amount of speculation that's going on right now. And they fail to acknowledge that during the GFC, the leading reason for decline during the GFC was not subprime. Subprime only made up probably less than 20%. I think it was slightly less than 20%. The bigger reason for the GFC decline was speculation, was an overwhelming amount of investors purchasing homes. Kind of similar to what's going on today. Either way, you guys, let's start visualizing the data right now and take a look at what happened week over week in the housing market. And don't forget this, we're just covering macro data. And honestly, even if we went into hyperlocal cities like Kingwood, like we've been studying, even if we did that, understand Redfin's all macro data. If you want like micro hyperlocal data, don't forget you have to do a subdivision analysis on the property that you want to purchase, which means you have to review sold homes. Sold homes are comps. You have to review the comps. Up to 3 comps is generally what you need for an appraisal. So you have to review the comps in the subdivision and track the trends that way. All right, so starting with median sales price, the speed at which the growth has started this year has started slowing down. I think this was at 6% year over year increase last week. It's now at 4.7%. And remember, you guys, year over year is comparing this right here. We didn't even hit a new peak last year. So again, we didn't even hit last. So remember, you guys, this is where the peak was, okay, in 2022. This is where the peak was in 2023. We didn't hit that from a median sales price standpoint. And also what I want to point out, and I'll get there when we look at inventory, is I'm going to circle, okay, right here. What you're seeing right here that I just circled was one of the fastest equity declines that we've had in history, which means on a nationwide level, prices went down from the point of where I circled roughly 12%. And what I'm trying to do here is show you guys during that period of time that I circled right there, again, prices going down, that's when we had the most inventory, active units that we've had in the last 4 years. And it was only 800 to 900,000. That's it. And look at the type of price decline we had. So I believe, honestly, you guys, all we need is a little bit more inventory to get a massive result in the housing market. We don't need 4 million like we hear people say all the time. We need about 200,000. That's it. And we can get that from several different places around the housing market. Either way, let's jump back in. Also, what's very interesting is we're starting to see some of the trends kind of reverse, and that may be a result of the higher interest rates or, getting to 7%. Honestly, I think we need to stay in 7%. But either way, you guys, median asking price is up year over year, 4.9%. But week over week, you can see that it did plateau out. So it is starting to slow down. What this means is people are starting to list their price of the house for a little bit more realistic. Okay, I just said a little bit more realistic. And that's what we see right there. So we're starting to see that slow down a little bit. Now we want that to start obviously going down. And I want to tell you guys is generally prices of houses generally don't go down until about June or July. So about right here, which means we have a few months left to get through before we know whether or not we're going to be okay this year, and before whether or not we even know that quantitative tightening, the interest rates, the lag effects, all of these things are working. So we got to get from that point to the other point. Okay, guys, so we almost have a new record for home buying housing payments. This is up 9.3% year over year. It's only $13 off of the record. Okay, the record being, I believe, last week. So a little bit of break, but right now the average mortgage payment being $2,700 is just not realistic when we look at the real income, or rather the lack of real wage growth. Real household income has been going down during times where home prices and home payments went up. And so what I'm saying specifically, you guys, is they have set us up to fail. But it's kind of like we're working the opposite way of last time. Last time we started with excess inventory. This time we have to get excess inventory. So it's kind of, things are starting in the reverse right now. But either way, mortgage payments right now on average, or even the median, way too high, incredibly toxic. And look at what it used to be. Just 3 years ago, y'all, we were way down here about $1,600, $1,700. Mortgage payments are over $1,000 more in just 3 years. Meanwhile, we are making less money. And that's why I'm saying it's not sustainable. We would have to make, okay, so for things to be sustainable, based on historical averages, 60% increase in income, okay? Prices would have to drop roughly 40%, okay? Or rates would have to drop to about 2%, and or a combination of all three of those things. In other words, you guys, the story is still being wrote. No one, absolutely no one, bear or bull, can make a blanket statement about what's going on in the housing market because things are so different. They're so divided. And look at the new home market. Now, bulls are like, it's just shrinkflation. It's just shrinkflation. But when we look at the data for new homes during Q4 of 2022 into Q1 of 2023, so that 6-month period, we had massive price decline of about 11%. So in only about 6 months, we had 11% price decline for new homes, but the size, both average and median, went up during that period of time. There was no shrinkflation during the fastest decline of new home prices. Remember that and look at the data. This is also super good, you guys. This is pending sales. This is down 3% year over year. This is exactly what we want. Now, when I was talking about what I expected to happen in 2024 with Jason and Walter, I had said, I think the home sales are going to be worse this year than last year. And he was like, what? And I was like, yeah, things are worse this year, right? And we see that. Now, it almost went over 2023, but look at that. It plateaued out. So keep your eyes on that, you guys. I'm very interested to see next week, will pending sales be more? Will they be less than last year? Either way, as I showed you, transactions are in the absolute gutter right now. Also, here's something that I'm keeping my eye on. Now, the article says this is because of Easter. Now, this is new listings of homes. This is also up 8% year over year. This is good, but we need more. So it's good. It's not great, but good, not great. But look at the trajectory, okay? So that trajectory went this way, but I also want to point out it does make sense that it was Easter because the same thing happened right there. Do y'all see that? And right here. So that decline downward, it may be seasonal. Now, here's something that I really love. Okay, now this is the point I wanted to make. This is active listings, okay? Now, remember, when I circled when price declined, okay, that was right here. Okay, so price decline was happening right here, what I just circled. Now, notice when price decline was happening, we had more inventory than we've had for the last 4 years. And so that's what I'm saying, you guys. And look, that's all under $1 million. $1 million's right where this arrow's at. Okay, so where I just circled, that's where $1 million's at. So we were even under 1 million active units. And so that's what I'm saying. If we can sustain 900 to 1 million active units, prices of houses, in my opinion, will go down for a period of time. Now, again, look at the trajectory. It did have a little bit of bump downward, but either way, you guys, we have a new 4-year high for this period of time. So we're starting the year in a good position. We don't want them to lower interest rates, especially being that we are making progress for the first time since, I will say, the start of 2023. Very abnormal trend here as well, you guys. I think we're seeing the interest rates really start to beat up the housing market. Regardless, supply is at 3.3 months of supply. We need to sustain 4 to 5 months. Now, technically, in order for the market to be considered a buyer's market, a sustained 6 months of supply needs to be available on the market. But again, look at the trajectory here. The trajectory is very interesting. Now, again, that could be a result of Easter, not 100%. You can see that we had a similar trajectory right here and kind of a similar trajectory right there. So I wouldn't pay too much attention to that. It's kind of hard to know what's going on there because on top of like normal seasonal fluctuations, we also have interest rates back in the 7%. Now, this is just probably the most shocking set of data of all. This is listings that had price cuts. So there are sellers that are waking up. This is like a super high, you guys. Like we hit new records. We have literally new records of price cuts. Unfortunately, we need those price cuts to go to median asking price and then from median asking price to median sales price. So we need even more price cuts. But the fact that we are so elevated, look at where we're at. We're at 5.6. Okay. This time last year, we were at about 4.5. In 2022, we were about 2.2. And in 2021, we were under 2%. So, in other words, price cuts are about double to triple where they're usually at, and they have been going up when they normally go down. That's beautiful. We want this to continue to set records. Okay, we want records to be crushed right now when it comes to price cuts. Here's another good set of data, you guys. Now, obviously, home buying demand is down substantially. I showed you several data sets of that. Now, here's their, Redfin's own way to calculate home buying demand index. It is down, according to their information, 11% year over year. And that is substantial considering 2023 was one of the worst years of real estate in 2 to 3 decades. So the fact that the demand is even lower this year should be very, very revealing. We're sitting right here, you guys. We're down substantially. And in other words, you guys, the high interest rates and quantitative tightening is working. Now, I get a question all the time. They're like, Travis, how is it that inventory is going up, but prices are also going up? The prices aren't going down. People always ask that. And the thing is, you guys, even though inventory is going up, demand, and this was especially, true to 2023, demand was just a little bit higher than the historically low inventory because we have historically low demand topped with historically low inventory. And so the question is, in 2024, which is going to be lower? Will we have enough inventory to match and exceed the demand? I think so. In fact, I don't even know how demand exceeded 2023. It blows my mind, actually, because it's very, very clear there's a lack of fundamentals. Now, again, do not forget, you guys, you always are going to want to use the data. Everything that we just went over right here, it's all macro. I don't care that we zoomed into cities. You got to go into localized subdivisions, access the comparable data. And what I like to do in my own housing market is to determine whether or not I'm getting a good deal for myself or for clients. I'm using 2021 average values to determine whether or not I'm getting a good deal. Okay, that's what I use. I use 2021, and based on how close I am to 2021 averages, I can determine whether or not I'm getting a good or even a great deal. But overall, you guys, the market is incredibly toxic, and people are still using their emotions to find great deals. You don't have to do that. Just use the data and simple math. That's it. You don't have to pay $10,000 for a home buying course. Okay, all you got to do is access data and use simple addition and subtraction. That's all it takes, you guys. All right. Now, if you want some more help, obviously I have a free home buying course. It is in the description. I teach you guys how to buy real estate. I also warn you guys not to buy real estate right now. Just not right now, unless you find a great deal and you know what that is and you're safe, right? All of those great things. But other than that, I really hope you guys enjoyed this video. I hope you guys like the new intro. Let me know if you like the new intro. Comment below. Let me know what you learned. And other than that, if you're out there investing in real estate, you guys already know I wish you luck and I hope you win.